Hi, this is Roger Schluter. This video right now is about what is an SBA 504 loan. The SBA 504 is financing for business fixed assets, and really fixed assets you're talking about real estate, equipment, furniture, fixtures, improvements to the building or the land. And the 504 is at a fixed rate of interest for a term of up to 25 years, which is a really big deal. There's not many lenders that would do that, or really, unless you're doing bond financing for larger companies. The maximum 504 amount is $5 million. SBA 504 loans are obtained usually through a CDC, Certified Development Company. They still have to, and the Certified Development Company really is the local partner of the SBA, and they work with both the borrower and the bank to go ahead and make this type of loan. For structure of the 504, the program works with local banks. The bank lends 50% of the loan, and SBA lends between 30 and 40%. And then the borrower puts in cash equity of between 10 and 20. Now the equity can be land or cash. So if you already had a plot of land you're going to build a building on, that would work out good. The land could be your 10% equity. Eligibility, they're for for-profit companies in the United States and in United States possessions. You have to have a tangible net worth of less than 15 million. And then you also have to have an average net income after federal taxes of less than 5 million for 2 years. So that gets you pretty high up, pretty larger companies when you're talking that amount. A lot of the companies we finance are smaller companies, and you'll be lucky if they have any equity at all, and their profits are probably in the range of maybe anything from 50,000 up to a couple $100,000. The property have to be user occupied or owned, either used by the owner or occupied by the owner. So if there's a building, it can't be rented out to somebody else. It has to be used by that owner. Now there is a way that they can go ahead and have what SBA calls it as an eligible passive company, but those are owned by the same people. So it's basically having one company that owns the real estate, leases it back to the operating company, and they let them do this for tax purposes. The ones that are not, that you can't use it for, is of course investor properties, where you're literally buying the property to rent it out. You're not going to use that property. And then nonprofits, they're not eligible. Passive or speculative endeavors are not eligible. And by speculative, they mean you're going to build a house and hope it gets sold, something like that. There's a few others, but you'll have to look those up. There's a few that aren't encountered that often. As I said before, the local bank does 50%. SBA can do up to 40%, and the borrower usually does equity of 10%. Now that's for an existing company. If you're a brand new company, you'd have to put in 15%. And then there is an additional 5% if the real estate has a special use designation. An example of this would be a hotel, where they can't really use it for anything else, so it's a special use. The bank always lends 50%, and it gets a first lien on the assets. The SBA amount depends really on the borrower equity. If the borrower's putting in 10%, the SBA amount is 40. If the borrower's putting in 15, then the SBA amount is 35. If the borrower is putting in 20%, then the SBA portion is 30. And like I said before, the loan is for fixed assets. Fixed assets is land and building and improvements, renovation for building, improvements on the land. It is for doing equipment, doing furniture, fixtures. A long time with the equipment, a lot of times they'll go ahead and let you put in the installation also for that equipment. The max SBA loan is $5 million, and this includes a small amount of upfront fees. Because SBA is kind of maxed out at 40%, the maximum project cost would be 12.5, and that's where the 40% would be. You'd break that out into a 50-40-10. The lowest amount an SBA portion could be is 25,000. There aren't many of those done. I'd be surprised if there's any, because most CDCs really want the lowest amount to be around 40 to 100,000, and that's really because they don't want to do a loan under 100,000. If you use that 25, you're really doing a loan of probably, about $60,000, which really a lot of certified development companies, there's a few fixed costs on it, and it really does kind of bring up the fees on it when you're doing these lower ones. The larger ones, they absorb those fees, and there's really no problem. There is a job requirement, and the job requirement is one job per 75,000. If you've got a manufacturer, it's one job per 125,000. You could also use the public policy as a way to meet the job criteria. Believe me, I've never been able not to meet the job criteria. I did have a company once, I think it was a bicycle retailer, and I asked her, I said, okay, and then with buying this company, in the next 2 years, if all your stars are lined up right, in the next 2 years, how many employees you're going to have? And she said 2. And I said, well, that's how many you have now. And she says, yes, I'm not really going to create any jobs. And I'm like, we need to create a couple jobs, but she would not give. So what we did was, her and her husband both own the company 50-50. There is, I told you, some of those public policy rules and regs. One of those is that women-owned businesses don't have to meet the job criteria. The other one is minorities don't have to meet the job criteria. So, like I said before, there's a number of these public policy things, and I've never had it. Usually I just ask them, if all your stars are lined up right, in the next 2 years, how many additional employees you're going to have, and usually they come out with the amount. The only way SBA really checks this to see if somebody's just making it up is if they're doing projections. They do look at the projections to say, do you have enough labor costs here? If you've got 25,000 for labor, but you're going to create 10, 15 jobs, that's kind of hard to do on that. You're not going to pay them 2 cents an hour or something. So anyway, the bank interest rate. Well, let's cover our interest rate first, or the SBA's interest rate. The SBA is tied to 10-year Treasury bill. The rule of thumb that I kind of use is that the rate would be the Treasury bill rate plus about 1.5% to 2%, depending on the times. But it is based on 10-year Treasury. At the time of this recording, 10-year Treasuries are at a pretty low rate. So right now the 504 is in demand. The bank interest rate is just their current rate. The bank has to do a 10-year note, but it does not have to fix the rate for 10 years. So usually a bank will fix it for like have a 3 to 5 year fixed note and it goes to variable for the remaining years, for the remaining like 7 to the remaining years on it. And then what'll happen is, at the end of that 3 or 5 years, they'll just redo the note and do it for another 3 or 5 years until they've hit that 10-year mark. Advantages of the 504, the really big advantage is that a lot of times, if you're an existing company, you're putting in equity of 10%. That's huge. I mean, most banks are gonna want you to put in equity of 20% or more. Probably the other one is that the other advantage is that fixed rate is up to 25 years. I mean, you don't get banks doing that. Larger companies might, really big companies, bigger than we can do with SBA. They may be doing, using insurance companies or using industrial bonds to finance that long. But, for a bank to do it, they're not going to give you a fixed rate for that long a time. It is a portion. It is not, you still got the bank financing of 50%, which is kind of conventional rates. but it does really help you. The whole 504 was really created to help businesses get some of their loan at a fixed rate for a long period of time, which really has not been done. Banks will do it 3 to 5 years, like I said, but usually no longer. That's the big advantage of it. SBA does have, I've seen it. It's not, the 504 is really made for good existing growing companies. They will do startups. So they follow a lot of the same rules and regs that the SBA 7A loan does. So really, there's a lot more give. The debt to equity is lower. It's like 1.1 instead of 1.2 to 1.3 that the banks would have. The credit's usually you can get by with a lot lower credit with SBA too, 504 or 7A. So really, there's advantages to it. So anyway, it's a great program, especially if you're doing something like a real estate, which is a fixed asset, which has a long life, and usually you can get you can do it for the 25 years. Equipment you can do 25 years if you have your normally it's done for 10, but if you can get the manufacturer to write you a letter saying it has a useful life of 20 years or 25 years, you can use either of those. And then the thing you got to remember is it's only for fixed assets. The 504 is not used for working capital. It's not used for inventory. And so because of that, you have to make arrangements if all of that is part of your project. So anyway, thank you very much. I do appreciate you sitting through the whole video. And just remember, if you got any value out of this, if you'd hit the like button, I'd appreciate it. And if you like content like this, like business loans and commercial lending, if you would go ahead and hit that subscribe button, and then also hit the notifications bell so I can give you notifications in the future when new videos come out. So anyway, thank you very much, and I'll see you in the next video.